ever wondered how to evaluate a company's stock? The answer lies in a powerful method known as fundamental analysis. This approach helps us determine the intrinsic value of a stock by analyzing various qualitative and quantitative factors. It's like being a detective, sifting through clues to figure out the true worth of a company. Unlike its cousin, technical analysis, which focuses on price movements and market trends, fundamental analysis dives deeper. It examines the underlying health and business fundamentals of a company. It's not just about whether a stock's price is going up or down, but why it's going up or down. Now you might be asking, why would we want to do all this work? Well, the purpose of fundamental analysis is to identify stocks that are either undervalued or overvalued. Undervalued stocks are like hidden gems, waiting to be discovered. They're stocks that are selling for less than what they're truly worth. On the other hand, overvalued stocks are like bubbles, ready to burst. They're stocks that are selling for more than they're worth. By conducting a fundamental analysis, we aim to avoid those bubbles and find those hidden gems. It's all about making informed investment decisions to achieve our long-term financial goals. Whether you're a seasoned investor or just starting your journey, understanding fundamental analysis can give you a significant edge. So, how do we conduct a fundamental analysis? Well, it involves examining a company's financial health, scrutinizing its management team, understanding its business model, assessing its industry position, and considering economic factors. It's a comprehensive approach that combines numbers with narrative, hard data with soft insights. In the world of investment, knowledge is power. The more we understand about a company and its stock, the better our investment decisions will be. And that's what fundamental analysis offers us, a deeper, richer understanding of a company's stock. Today, you will learn how to conduct a fundamental analysis. So get ready to dive into the fascinating world of stocks and investments, where numbers tell a story and every company has a tale to tell. First, you need to understand the key components of fundamental analysis. There are 5 main pillars to consider: financial health, the management team, the business model, the industry position, and economic factors. Let's start with financial health. This involves a deep dive into a company's financial statements, which include the income statement, balance sheet, and cash flow statement. By examining these documents, you gain insights into the company's revenue, expenses, assets, liabilities, and cash flows over a specific period. Next, we have the management team. The quality and competence of the individuals leading a company significantly impact its future performance. By evaluating the leadership's track record, strategic decisions, and corporate governance practices, you can get a glimpse into the company's potential growth prospects. The third component is the business model. To assess a company's long-term sustainability and profitability, you need to understand its products or services, target market, competitive advantage, and revenue streams. These elements offer valuable insights into the company's potential for success. The fourth component, industry position, helps you comprehend the company's competitive landscape. By evaluating its market share, growth potential, industry trends, regulatory environment, and technological advancements, you can better understand the dynamics of the company's performance and valuation. Finally, we have economic factors. Macroeconomic elements such as GDP growth, inflation rates, interest rates, and consumer sentiment all play a crucial role in shaping a company's operations, sales, and profitability. Understanding these factors can help you anticipate potential impacts on the company's financial health. So, to sum it all up, fundamental analysis is a comprehensive method of evaluating a company's stock. It involves examining a company's financial health, scrutinizing the management team, understanding the business model, assessing the industry position, and considering economic factors. Each of these components plays a significant role in determining a company's intrinsic value. Remember, each component plays a significant role in determining a company's intrinsic value. Now, let's talk about the tools you will need for fundamental analysis. To start off, one of the most essential tools in your fundamental analysis toolbox is the company's financial statements. These include the balance sheet, income statement, and cash flow statement. These documents are like the company's financial diary, revealing the story of its revenues, expenditures, assets, and liabilities. By analyzing these statements, you can gain a clear picture of the company's financial health and stability. Next, we have financial ratios. These are numerical relationships derived from the financial statements, and they are key indicators of a company's performance. Some common financial ratios include the price-to-earnings ratio, which compares a company's stock price to its earnings per share, and the debt-to-equity ratio, which measures a company's financial leverage. Other ratios, like return on equity and price-to-book, provide insights into a company's profitability and valuation. These ratios, when used correctly, can help you make informed decisions about whether a company's stock is overvalued or undervalued. But fundamental analysis isn't only about numbers. It also involves qualitative analysis. This means considering non-numeric factors that might affect a company's performance. For instance, the quality of a company's management team, its competitive advantage, and its position within the industry can all play crucial roles in its success. By incorporating qualitative analysis into your approach, you add a layer of depth to your understanding of a company beyond what numbers alone can provide. In essence, the financial statements give you the raw data, the financial ratios help you interpret that data, and the qualitative analysis provides context to both. Together, these tools enable you to conduct a comprehensive evaluation of a company's intrinsic value and its potential for growth. These tools will provide you with a comprehensive view of a company's financial health and future prospects. Remember, the goal of fundamental analysis is not to predict market trends, but to assess the value of a company's stock based on its fundamentals. By mastering these tools, you're well on your way to making informed investment decisions. Ready to conduct your first fundamental analysis? Let's dive right in. Step 1. Begin by analyzing the financial health of the company. This involves examining the company's financial statements, including the income statement, balance sheet, and cash flow statement. Look for trends in revenue, expenses, assets, liabilities, and cash flows. Remember, a healthy company should show a consistent growth in revenue, a manageable level of debt, and positive cash flows. Step 2. Evaluate the management team. This includes assessing the leadership's track record, strategic decisions, and corporate governance practices. A company with a competent and ethical management team is more likely to succeed in the long run. Step 3. Understand the company's business model. What products or services does it offer? Who are its target customers? What is its competitive advantage? A strong business model should be sustainable, profitable, and capable of adapting to changes in the market. Step 4. Assess the company's industry position. Consider factors such as its market share, competitive landscape, industry trends, regulatory environment, and technological advancements. A company that is well-positioned within its industry is likely to have a brighter future. Step 5. Consider the broader economic factors. How will changes in GDP growth, inflation rates, interest rates, and consumer sentiment affect the company? Keep in mind that a company's performance can be influenced by both domestic and global economic conditions. Now, let's talk about the tools you can use. Financial ratios like the price-to-earnings ratio, price-to-book ratio, return on equity, and debt-to-equity ratio can provide insights into the company's valuation, profitability, leverage, and efficiency. Additionally, don't disregard the importance of qualitative analysis. This can provide context and deeper understanding beyond numerical metrics. Remember, the primary purpose of fundamental analysis is to identify stocks that are either undervalued or overvalued. By carefully analyzing the company's financial health, management quality, business fundamentals, and industry dynamics, you can make informed investment decisions. Congratulations! You have just completed your first fundamental analysis. Let's recap what you've learned today. We've taken a deep dive into the world of fundamental analysis, a method that financial whizzes and savvy investors use to assess a company's stock by examining its various qualitative and quantitative factors. By doing so, they aim to determine its intrinsic value and make informed investment decisions. We've talked about the 5 key components of fundamental analysis: First, we've learned that a company's financial health can be assessed by studying its financial statements, giving us insights into its revenue, expenses, assets, liabilities, and cash flows. Next, we've discussed the importance of evaluating the quality and competence of a company's management team. By looking at the leadership's track record, strategic decisions, and governance practices, we can get a glimpse into the company's future performance and growth prospects. We've also discussed the importance of understanding the company's business model. This includes examining its products or services, target market, competitive advantage, and revenue streams. This helps us assess its long-term sustainability and profitability. Our fourth key component was the company's position within its industry. This helps us understand its competitive landscape, market share, and growth potential. Finally, we've learned that fundamental analysis also considers macroeconomic factors such as GDP growth, inflation rates, interest rates, and consumer sentiment. We also touched on the various tools used in fundamental analysis. These include financial statements, financial ratios like the price-to-earnings ratio, price-to-book ratio, return on equity and debt-to-equity ratio, and qualitative analysis, which provides context and deeper understanding beyond numerical metrics. The primary purpose of all this? To identify stocks that are either undervalued or overvalued based on their fundamental attributes. By analyzing the company's financial health, management quality, business fundamentals, and industry dynamics, investors aim to make informed investment decisions and achieve long-term financial goals. With these steps, evaluating a company's stock through fundamental analysis becomes an achievable task. Thank you for tuning in, and remember, practice makes perfect in the world of stock analysis.